when you're talking transferring $2.5 billion of cash intraday, there's a lot of credit risk in that. A bank might go bust. And we had to deal with what happened if a bank went bust while that $2.5 billion was working its way through that horse and buggy back end system.
Wow. The bank that I worked at, the biggest bank in my country, the whole language on the mainframe, like the whole core of
COBOL.
The software is COBOL, yes. So that is globally used. There's like maybe one person that kind of can touch the architecture. And there's like 3 guys like on call for when something breaks, like literally they send a chopper or something. Like that's when I really realized, this number in your banking app is literally just a number in a database. It does not represent anything of value. All right, Caitlin Long, welcome to Bitcoin for Millennials.
Yeah, great to see you. Great to be here. Thank you.
Yeah, well, thanks so much for coming on. I've been a long time follower of you. I love your enthusiasm for Bitcoin. I think for me, you are a poster person that displays that. So I'm happy to have a chat with you today. So thanks so much. I wanted to start with, I saw a tweet of you that is from, 2023, but I saved it actually when we scheduled this. And it's a clip of Cynthia Lummis who asks a guy named Barr. I don't know who that was actually, but she asks him the question, is fractional reserve banking risky in the age of online banking? And you tweeted, this is the question in banking right now. Is a bank's business model of borrowing, short-term and lending long-term with leverage, does that work in the digital age? And I thought it would be an interesting topic to start with. And basically my question is, if the banks have reserve requirements, ratios that are zero, is the US banking system safe and sound, as we hear so much?
Well, that is the question, right? If you look at the Fed's aggregate data in what's called the Z1 report, large banking organizations have about 12 cents in cash against their demand deposits. So it would only take 12% of their demand deposits to run for them to need extra liquidity. And that's the larger banks. The smaller banks, it's about 8 cents. So in aggregate, it's somewhere around 10 cents, a little over, because the larger banks are quite large. But there are so many more smaller banks in the United States, so huge quantity of smaller banks. Outside the U.S., the banking system is a lot more concentrated. The U.S. has always had a lot more decentralization in its banks because we have these institutions called community banks. There's something around 10,000 community banks and credit unions, and then, of course, the large banks. But the large banking organizations have more than half of the deposits, and they have something like 95% of the payment volume on the ACH rails. They're absolutely dominant. Even like the top 5 banks just dominate. So it's an unusual banking system. So anyway, with that backdrop, the numbers I gave you, call it on average 10 cents. Those are the reserves. So your point is well taken. There's no reserve requirement anymore in the banking system. The Fed reversed that a couple of years ago, but there's a capital requirement and there are liquidity requirements. So it's not as though it's freewheeling and there's no regulation. In fact, the banking system is the most over-regulated industry in the United States. Everything is prescribed. That's also why the tech is so backwards, and it's also why there's almost no innovation. And so they look at people like me who, worked inside the banking system for a long time and tries to go innovate from within. And they try to chew you up and spit you out because they don't want innovation. The current set of regulators is very anti-technology innovation. And there's a lot of regulatory capture, unfortunately, at the federal level.
I think it's so interesting. I talked with Ella Huff that you might know.
Mm-hmm.
And we talked about, when you were younger, you have maybe some coins and some notes and you're very happy with that, right? And you save them somewhere. And she said, I remembered when I turned 12 or something. And I went with my mother to a bank to deposit the money in the bank, right? And then she said, later, I realized that was the dumbest thing that I could do, right? Because with fractional reserve banking, they basically, you lend it to the bank and it becomes this IOU, and physically it's not yours anymore. Contractually, it's not yours anymore. And I find it so interesting. I have some years in my career where I worked in TradFi as well, and I learned only when I was 30 that, it works like this. And we talked about like, it's so strange that no one ever really teaches us like how this works, right? It's just
For sure.
basically you take your kid to the bank and, deposit and you get a little card or whatever. What do you think is the biggest thing that people need to learn about this system? Even before we can talk about why Bitcoin should exist, etc. Like, what is the main thing for you?
It's a Ferrari front end, but a horse and buggy back end. So even when you use, say in the US, Venmo or PayPal, or you use some of the international remittance plays, because I know you've got an international audience, unless you're using Bitcoin native rails, that's going through the old school systems, which are not even API based. So it's really antiquated. What's happened in the US is that the fintech industry has created these technology-enabled applications that we're so used to using, including something like a Venmo or a PayPal. But what's happening is on the back end, all of the actual payments are still running through those old school rails. And there hasn't really been innovation in the payment system since the 1970s in the United States. Now, there is something called FedNow, which is new and is better by far from the perspective of the technology use, but there's a lot more surveillance on FedNow because it does cut out a lot of middlemen. It goes straight to the government as a counterparty, and it goes through your bank, but it's a real-time 24/7 US dollar system. But so few banks, because they just don't have the technology to integrate in with that. So few banks have, and because of the surveillance issues and the fact that, I mean, there have been some people who have said that FedNow is effectively a central bank digital currency. Yeah. And they're not entirely wrong. They're absolutely wrong when it comes to describing how the technology works, because that is a centralized system, API based. And that's part of the reason why so few banks have signed up for it, because they don't have the technology. Like I said, they're dealing with horse and buggy backends. That's where their systems are. A lot of banks don't even have, of those 10,000 credit unions and small institutions in the United States, a lot of them don't have engineers at all, right? Yeah. So they're not really software companies. They're using software applications, but they're not providing any software-based services. And that's an important difference. So that explains, frankly, why very few have plugged into FedNow and it hasn't really taken off. There's a movement in Congress that Richie Torres put forward a bill in the US Congress to give the remittance companies direct access to the payment rails and to FedNow, as opposed to having to go through the banks. And the problem with something like that, I know from having dealt with trying to integrate into the Fed, trying to get access to those same payment rails, is there's a gigantic technology mismatch, right? And ultimately, and this is probably why you started this podcast with the question about fractional reserve banking. Everything's moving a lot faster, right? And especially the millennials, your audience, how many of you have ever set foot in a bank branch? It's kind of like Ella talking about the weird experience of going to a bank branch to deposit some cash or to deposit a check, right? How many of you have never written a check? So these are just old school things that are being supplanted by technology, and especially the millennial generation and younger you grew up with the internet. I'm a Gen Xer, born in 1969. So I remember when, we got our first computer and how backwards it was. And, thinking back on it now, it's the incredible leap that we've had in technology since then. But I didn't grow up with an internet native upbringing. You did. And so you're totally used to, with games, for example, tokens having value, right? The notion of something being natively digital that has value is not foreign to you, but it is absolutely foreign to my generation, and especially to my parents' and grandparents' generations.
Are you looking to save in Bitcoin for your retirement? Meet OnRamp, the leader in Bitcoin financial services. OnRamp has just launched the industry's first Bitcoin IRA with multi-institution custody. That means unparalleled support, transparency, and peace of mind for your retirement. With OnRamp, you can verify your assets directly on-chain and protect them with the support of 3 independent institutions, eliminating the risks of a single point of failure. Are you ready to take control of your Bitcoin retirement? Visit the link below or go to onrampbitcoin.com to learn more about OnRamp's Bitcoin IRA. think it's really interesting that you said Ferrari in the front and horse and buggy in the back, because the bank that I worked at is the biggest bank in my country. And I used to work in like the innovation department. And we once went to like the data center and we got like, a tour, etc.
Yeah.
And then I learned that, like the whole language on the mainframe, like the whole core of
COBOL.
the software is COBOL. Yes. So that is globally used.
Right.
And then this guy who gave us a tour said like, there's like maybe one person that kind of can touch the architecture. And there's like 3 guys like on call for when something breaks. Like literally they send a chopper or something. Like they are highly paid.
Yes.
Because they are the only people that
Correct.
like basically are allowed to touch it.
Yeah.
And when I heard that, I was like, what? And because when I got back to HQ, you also see that like half of the IT is outsourced to India in this case, biggest bank in my country. Okay. And I remember after having that tour that day, I was like, okay, so there's like one person that is like allowed to like touch it, just touch it, right? And there's like 3 guys that can actually work on it, right? And I was already into Bitcoin at that point, but that's when I really realized, this number in your banking app is literally just a number in a database. It does not represent anything of value, like you said, like if you have a tangible coin or it's yours, also like with Bitcoin, like it's really, really yours, it's your property, right? Just the impact of that is so significant. And I that talked about this a lot on the podcast. You have to realize that the number in your banking app is literally a number in a database, and that even in the most extreme case, do you think the Russians know where all the data centers are? Yeah, probably, right? So let's say
I bet they do. Sure.
Let's say you nuke a data center. Everything you worked for is literally gone. Like, because you have to trust a third party again to do some audit. Like, oh, you had this number in your little database table, and you had, like, it is so antiquated. It is very, very scary to realize that. And
the banks globally are just moving to cloud. The outside of the U.S. is moving a lot faster than inside the U.S. But cloud-based, API-based systems, these are like you said, in the old traditional banks, they're just moving to these technologies. They just weren't ready for anything digitally native. This is a stepwise change. It's a paradigm shift. And part of the reason that they're pursuing regulatory capture strategies, which unfortunately have been effective to some degree, keeping the crypto industry out, it's not because we're going to pose unusual risk to the system that can't be managed. Not at all. It's because they're protecting the incumbents who are still dealing with COBOL. And they recognize this is a stepwise change, right? It's just a massive shift. And it just obsoletes all of those old systems. And those banks have spent billions in some cases to maintain them, to build them and maintain them, and they're immediately obsolete. So those banks are just going to be using the regulators who have allowed themselves, unfortunately, in too many cases to be used, especially by the big banks, to protect their turf against competitors coming in. And in the US, the Fed, very few people know what the structure of the Fed is. There is a federal agency, which is an umbrella over 12 privately owned banks, the regional Federal Reserve banks, that are controlled by the banks and owned by the banks. And that's where the balance sheets are, is in these 12 regional Federal Reserve banks. They're in New York, San Francisco, Kansas City, Dallas, Minneapolis, Chicago, right? They're in, major cities of the US. And they were designed to be decentralized. Originally, when the US was setting up the Fed, they looked at the Bank of England and said, well, we kind of want to copy that, but we want to push power out into the hinterlands of the US. And this was 1913. Transportation was not easy like it is today. So they tried to decentralize it, but they created later in the 30s this umbrella organization that sits over it. And what has happened, of course, since then is those 12 regional Federal Reserve banks, which were autonomous in the beginning, each one of them had their own monetary policy. Each one of them set their own discount rates. And increasingly, there was a creeping centralization of control into DC. But stop and think about the implications of that. The private sector controls monetary policy. They can vote to pay themselves interest, and again, stop and think about also the antitrust implications of keeping competitors out. If they're the ones making the decisions not to let new banks in, including companies like Custodia, like between the agency and the in our case the Kansas City Federal Reserve Bank, pretty clear the agency told Kansas City to leave Custodia out. That's not what the judge concluded at the district court case, but by concluding that the privately held Kansas City Fed voted to keep a competitor out, that opened all kinds of other issues in the case. And so it's I'm looking forward to getting our day in court. We have our date scheduled on January 21st, which is the day after the inauguration of President Trump.
Maybe that helps. Yeah, I'm rooting for you, but I think this is a fascinating example, right? They basically lost already in a sense. Just on the technology part, we always said when I worked at the bank, like this bank is already defragmented, right? Like there's like 25,000 fintech startups in the world, and they all pick a little part of this financial conglomerate, and then they just do that part better, basically. And we always said, like, yeah, it's just like catch up. But when you think about this code, right, like it's kind of like this loss aversion or something. Like they are looking for external sources to keep external, like the competitors out. And I think these are these little things that, like, along the way of a Bitcoin journey, you come across. I've always treated it as like kind of like a signal, like a bank is just a business. Well, a fractional reserve bank is more of a business, different business than a full reserve bank, of course. But it's not like they have a charity or something. Like they need to make money. So I think the trust that people have and the enthusiasm when they're little kids and they bring the coins and the bills to the bank, right? Like it's all part of this scheme to keep that together. And the last part you mentioned about Federal Reserve, like it's not federal and there's not a reserve, right? That is another thing, So there's these little tidbits along the way. And I wanted to ask you, like, what made Bitcoin click for you? Because I think you, like on my journey, I've came across several people that come from a TradFi world who are super orange pilled, right? And I think also the people that I've seen in the TradFi world, like, people are in a golden cage, right? They are not incentivized to think outside of the box and be creative and challenge, etc. And you going from that to Bitcoin, I think, is a pretty big switch. So, like, how did that go for you? What made it click for you?
Well, it was also back when I was worried I'd get fired. I was a managing director at Morgan Stanley in New York at the time, and seriously worried about getting fired. And Jamie Dimon, I think, a year later, uttered for the first time that anybody involved in Bitcoin he would fire. Right. So we were all afraid. There were several of us in New York at the time who would go to the Bitcoin meetups. And I was in Times Square at Morgan Stanley's headquarters. Pillsbury was also located. It was a big law firm. Marco Santori, who's most recently the chief legal officer of Kraken, he was at Pillsbury at that time, and he would host some of the Bitcoin meetups. And so I would just walk across Times Square, but I would take all my Morgan Stanley gear off. I was definitely, as much as possible, keeping my head down, not sharing with people where I was working, because all of us were afraid. It was interesting. The only investment bank at the time that was, at least where the people didn't fear the impact of being involved in a new innovation like this, was Goldman. I have actually saluted Goldman Sachs because they actually encouraged their employees to be curious in a way that really no other bank did. I never saw any others that encouraged, curiosity. But what was orange pilled? I've shared this, but it's been a while. So I'm glad you've asked this story. I was working on a huge transaction in 2012 between the General Motors Pension Fund and Prudential, the life insurance company. General Motors was buying annuities for its pensioners to satisfy its pension obligations and transfer those over to the insurance company. So they were prepaying for the annuities. And we had to figure out how to transfer $29 billion. Well, you immediately, as a Bitcoiner, understand the problem, right? We were talking about the antiquated system. Part of how I understood how antiquated that system was working on that General Motors Prudential pension transaction now 12 years ago. Because just to move, we moved, I think, $2.5 billion of cash. You would think that would be easy on FedWire, but when two banks moved $2.5 billion same day, we had to get the New York Fed involved in that just to make sure that, because the other constraint we were working under was that all of the assets and all of the cash had to move same day. And if it didn't, if even a dollar didn't move same day, the entire transaction had to be unwound same day. And we were moving fixed income. So, a lot of corporate bonds. We were moving private equity. We were moving some real estate. And then we were moving a lot of cash. But the biggest piece was securities. Now, it turned out that was actually the easiest part, because securities at that point settled 3 days after the trade date. Remember, everything had to go same day. So for the securities, we were able to just sign over the ownership of the custodial account. So they didn't actually have to cycle the securities through broker dealers and sell them over from the General Motors Pension Fund to Prudential.
Yeah.
But so it was really basically just transferring ownership of a custody account. Same thing, it turns out, but there were rights of first refusal and rights of first offer and things like that in the private equity. So that also was going to take more than a day, but we figured out how to do it in an IOU type structure. The funniest part was, I remember having this aha moment when we were negotiating this huge first of its kind transaction, very complicated, and we actually practiced the transaction for 2 months, because again, if any asset didn't make it over in same day, the whole thing had to be unwound same day. Otherwise, you would have been in violation of a whole bunch of laws. So we had to practice it, and huge interest rate risk and everything, like really big transaction. But I remember this aha moment when we were negotiating the contract, and we had to define what's cash. Well, cash is different things to different people. What's money, right? It blew everybody's mind, because I literally said, do you want us to send bricks trucks filled with $100 bills? Because it turns out that transferring cash, when you're talking transferring $2.5 billion of cash intraday, there's a lot of credit risk in that, because of what you just asked me about at the very beginning of this podcast. A bank might go bust. And we had to deal with what happened if a bank went bust while that $2.5 billion was working its way through that horse and buggy back end system.
Wow.
Yeah. And it turns out we actually spent a lot of time talking about that. And the funny thing is, when all the papers got mailed out, there were something like 10,000, actually more than that, retirees that were impacted by this transaction. They actually brought semi-trucks filled with the mailings, and all of that got mailed, had to get mailed at a particular time. Like the orchestration of this thing was incredible.
Fascinating.
And anyway, so now you can see why, like when I'm in the middle of that in 2012, and I'm trying to figure out, this should be so simple, and it's just not. And lo and behold, here comes Bitcoin, and I was like, yeah. I grabbed onto it. Also, I was working through some alternative school of economic thought. I was doing a lot of reading around that time after the financial crisis, because I was working on a trading floor in Times Square at Morgan Stanley when all that was happening. Went on a very deep dive, and long story short, came across Jeffrey Tucker, who's somebody who I'm sure a lot of your audience knows. He's really the person I credit for orange pilling me. And he had a private mailing list called liberty.me back then. And I started to see Bitcoin in the Austrian school, mailing lists and things. Back then it was mostly email that I was working, that I was regularly reading. And then Jeffrey sent a big post. It was February 2013. And I distinctly remember it because I had surgery at that time and was recovering and had time to go on a deep dive. And I did. And that's when I started to go down the rabbit hole and have never come back out.
Love that. What I take from that story is one, so the number you see is not necessarily there.
Correct.
Two, what is it all attached to? It's basically, when you were talking, I was thinking, you're moving like parts of a ledger. You're like cutting parts of the ledger of one bank, and you're shoving it into a certain part of the ledger of the other bank, right? But
correct.
It's not like that is an isolated thing, right? Like it's attached to thing, it's securitized or whatever. Like there's all these, well, maybe products or agreements or whatever attached to this little part that you cut out. Yeah, interesting. And the second thing I'm thinking is like, it's a good example because transactions like this exist, right? This is a big deal, but I mean, it exists, right? So there is a use case for
same day transactions. Absolutely.
Of billions of dollars.
Of billions. And I was just talking with some longtime friends.
Was this in the city? Sorry, was this in the city?
It was in New York.
Mm-hmm. Also, yeah. But imagine it was in even Boston or LA or Hong Kong, right?
Yeah. Well, I mean, like I told you, we spent 2 months practicing the orchestration of this. I mean, probably called the New York Fed a couple weeks before to tell them this big transaction is coming between two non-banks. Two banks moving $2.5 billion, that happens every day. But two non-banks moving $2.5 billion to each other, it had to go from, well, I frequently talk about foreign exchange transactions. That's probably a better example. Just the number of data centers rather that are impacted by TradFi transactions. If I'm moving money to London from New York, what's going to end up happening is my bank is probably, let's say I use a small bank and then like a building society in London. So the small bank on the corner of, Queens in New York is probably going to clear their transactions through a Citi or a JP Morgan, which then have to clear through the Fed, which then go to the Bank of England, which then have to clear through a clearing bank at, say, Barclays, and then to the building society. Okay, you're talking...
So it goes like up, across, and down, right?
Correct. And that's hitting a data center every single time. So it hit me that the technology of blockchains, distributed systems, is designed to solve the duplication and reconciliation problem. And that's where Satoshi was going. Like, let's solve the duplication and reconciliation problem. If we can have one golden copy, one single ledger that we all agree is accurate, and we can trust it, then we don't need to duplicate and reconcile that data. And a lot of people,
that's
especially
a productivity gain in a sense, right?
Huge, but it's more than that. It's also green, because a lot of people don't think about the financial services industry being the energy hog that it is. And they look at Bitcoin and say, oh, Bitcoin's an energy hog. Are you kidding? It is so much more efficient, because that transaction I just described, moving money to London from a corner bank in Queens to a building society in the burbs in London, that hits 6 different data centers. And it used to be, well, it still is, that all of those steps had to be done in sequence. Now, there's a lot more real time or fast updating. It used to all be done overnight, which is part of the reason why it took so long. That's why securities they settled trade date plus 3 days, because you were typically going through 4 to 6 data centers, and it all had to be done sequentially for a transaction to settle. Long ago, these problems were solved by technology. Why is it that the financial system has lagged so much? It's because they're protected by regulators, and the incentives are misaligned in the regulators as well. Go look at some of the people who are overseeing supervision and regulation at the bank regulators. They're career regulators, and they've worked their way up in these agencies, and they've been in their jobs for 35 years. Have they ever had to learn anything new from a technology perspective? Probably not. So it's so fascinating to me. Elon Musk, we're recording this on Thursday, right after Gary Gensler announced that he is resigning. He's retiring. I don't know if he said retiring or resigning, right on Inauguration Day. Elon Musk started trolling him within an hour and said, I understand that the SEC employees aren't coming to work every day. Or, how many hours a day are they coming to work, right? And it's so interesting, because you got a guy who really is frustrated by and has been attacked with lawfare in really all of his businesses from federal agencies in the United States, including and especially the SEC, who have personally sued Elon Musk. And man, when he's trolling Gary Gensler, he's got an axe to grind, but he's also got a point, right? Yeah. Because he's a technologist, and he's looking at all the sand that's been thrown in the wheels of innovators in the United States and saying, this is over. It's innovation time. And thank goodness.
Yeah, so many things to pull on, but I think the innovation, I mean, like, I always think we are all lazy, so we would love to have progression in productivity or some optimization of some speed or processes or whatever, right? And everything that you just shared is the total opposite of that. So
correct.
What is the incentive or the motivation to keep it like that, right? And you cannot, there is no rational or logical way where you end up with a very positive argument for keeping it like that, and
yeah. Of course not. It's just to protect the incumbents.
Exactly.
Right.
But it's not a nice realization either. And I think that's what people struggle with. It's just, this is complex, A, but B, when you get to the conclusion, when you dive into it, it's like, okay, so I'm participating in a system. This was my realization, right? I'm participating in a system that I have no clue about. And even, again, your example, even when you're moving billions, You need all these separate entities to allow you
Correct.
to do that, right? So is that money, or what is money, right? Or are these units or whatever the numbers, right? Are they even yours? Like that's the second thing that I then think, right? Yeah. So
no.
And it's easier to say because we get Bitcoin, but I think it's very important that we talk about this more, and after that we talk about Bitcoin, right? Because people have to understand. No, like not just us. I mean, like in general, right? Like just more about the problem than Bitcoin is a solution. It's better. Yeah, better than what? Better than something that most people have no clue about, right? So they need to get that they have a problem in a sense, and I think that's a hard thing when it comes to the adoption of Bitcoin. That pitching a better thing is kind of futile if people don't really know what it solves for them, right? So I think it's a really nice example that you gave, and when you're at a bank, you're even in the sort of like upper echelon of finance. You're not a pleb that wants to, I don't know, buy a house or send money to their family in, whatever country. Like that is just totally different use case.
Yeah.
Quick question. If you have your Bitcoin in self-custody, where are you keeping your Bitcoin seed words? For me, there's only one way, and it's backing up my seed phrase with stamp seed. It's a single durable plate without any parts or materials. Stamp your words into solid titanium, which is fire-resistant, water-resistant, and built to last. Unlike etching or engraving, stamp seed's patented tools help you to deeply stamp every letter for permanent readability, making it easy for you to protect your generational wealth. Don't risk losing your seed phrase on paper. Get a stamp seed plate for unmatched protection. You can use code BRAM, that's BRAM, for 15% off at stampseed.com.
Well, and that's why I'm so happy that Bitcoin is taking off in countries that don't have well-developed banking systems. Bitcoin's not a U.S. story. In the U.S., it's digital gold, and it's a new commodity, and the number go up crowd loves trading it because it's high volatility, and Wall Street's coming, and all that's true. And I'm not saying that's all bad. I do have some concerns long-term about concentration of Wall Street and about the financialization of Bitcoin and creating paper Bitcoin, and a lot of people not realizing that the problems we're just describing with the banking system and with securities, where you don't really own your assets, all you own is an IOU from a leveraged counterparty that might go bust. Yeah. Okay, we're starting to get that with Bitcoin too. A lot of people leg into Bitcoin through ETFs or through, wrappers, financialization wrappers and they think they own Bitcoin, but they don't really, because they're not controlling their private keys. In order to really own Bitcoin, you have to control your private keys. Otherwise, all you own is an IOU, and you've just recreated the same problems that were in the existing system. Yeah, for sure.
No, but that's also what I meant with this adoption thing. Like, you have to understand the problem, because then you are motivated to actually study, and then you can get to the point where you understand what you just said, right? Like, it's the most valuable if you have actual ownership of it, right? Like when you use it as the bearer asset that it is. But I think, that's like step 5 or something.
Well, for everybody, right?
Yeah. So it's
hard. And I think back to in my era, a lot of people are saying today, "Oh, it's so hard. It's so hard." You're absolutely right. But I started to deal with the self-custody question before ledgers and Trezors came out. So, I mean, back then, and even still today, a lot of people just buy Bitcoin on an exchange and leave it there. Yep. And I was part of the group. Trace Mayer was the first person to have a proof of keys day. He invented that idea on January 5th, which is the date of the anniversary of the first Bitcoin block being mined, to have a proof of keys day. And in the early years, I think he started in 2014, maybe 2015, you actually saw a noticeable change in the amount of coins kept on exchanges. Now it's kind of getting lost in the whole discussion because the ETFs have taken off. And I just had this debate, like I said earlier, with longtime friends who are, I orange pilled one of them. He was very anti-Bitcoin. He's my mentor. He just hated it. He was a gold bug, could not, a mentor in Austrian School Economics, and he just couldn't understand Bitcoin at all. And then I finally prevailed, and he's my proudest orange pill when the student teaches the teacher.
Yes.
It's really fun. But now he's more orange pilled than I am because he's really committed to the MicroStrategy model and to the notion that leverage is okay when you're borrowing in US dollars and you're arbitraging your cost of capital, which is the way MicroStrategy is. He's all into, sovereign wealth funds and the like, owning Bitcoin, because we just have a different paradigm now. We've actually had not just a paradigm shift in terms of the technology that, as we were talking about earlier, versus TradFi. There's something new and different in the notion that Bitcoin as a reserve asset opens up all kinds of possibilities. And Ricardo Salinas had a really good summation of it earlier this week. I retweeted him. The bottom line is Bitcoin is an asset with no entropy. Michael Saylor talks about this as well.
Yeah. It doesn't degrade, basically.
It doesn't degrade, exactly. Yeah. So it's not just that you're getting ahead of inflation because the inflation rate of Bitcoin is half of the inflation rate of gold right now, which is a fraction of the inflation rate in most fiat currencies. That's absolutely true, but it's more than that. It's that there is no degradation, there is no entropy. If you own real estate, if you own commodities, you're going to have maintenance costs. You're going to have some shrinkage in the corn that's never 100. Not every kernel is going to make it from the farm to the table in the transportation, right? You're going to have degradation. And every hard asset has that. Yeah. And gold in particular has a lot of transaction costs because transportation costs are high. You've got to buy insurance and you've got to assay it, all of those things, right? But you just don't have that with Bitcoin. So I look at all this coming back to the self-custody question and your ability to own your own Bitcoin and to be a true first-class citizen of the Bitcoin ecosystem. Only those who control your keys are the first-class citizens. Everybody else is a second-class citizen, and then what you've done is cede control to a leveraged counterparty that may not have the same interest as you. And this is where we get into some of the debates about Bitcoin. What if there's a contentious soft fork again? UASF, right? We users of the Bitcoin network, the people who run the nodes, it's not just enough to custody your keys. You're really only a first-class citizen in the Bitcoin ecosystem if you run a full node. And the node users were the ones who voted with our feet on the UASF soft fork, right? And what if there's going to be something like that coming up and it's a Bitcoin custodian who has to vote with their feet at that point? And even like institutional custodians, it's just so fascinating that Saylor doesn't talk a lot about self-custody. And that's one of the challenges. I'm quite sure he's thought about it. But when you realize that one of the biggest risks to MicroStrategy or to the ETFs is just the custodians being hacked. Now, it's a really interesting and very different way to think about risk that I don't even think most of the people on Wall Street are even thinking about.
Yeah, it's interesting. When I worked at that bank, I worked a lot also at the risk department. And now that you mentioned this, I think like this would never fly at a TradFi bank, right? So
correct.
That's a very interesting observation, and I fully agree. I do think, like conceptually, I believe that once kind of like adopting Bitcoin forces you to like follow the rules and kind of like the principles and values, right? So I mean, if people would demand of BlackRock or IBIT, I think IBIT, Bitwise, they are sharing their key public, I think. But
there's a proof of keys,
exactly. But BlackRock didn't do that, right? So I think Bitwise is the only one, for example. Like, if enough people demand it and they don't do it, that says enough conceptually, right? Like in Bitcoin. So it's like show me what you got. If you don't, then you don't. Like I don't believe you, right? So because there's a truth that you can force someone else to show, and if they don't show it, you cannot trust them, basically. I think that's the point.
And then there's now with options on the ETFs being traded, now we've got all this pressure for real-time availability. Step back. Satoshi didn't envision a system with real-time availability. The average block interval is 10 minutes. That's not real time. So how is it that all this real-time availability is happening? There's an awful lot of IOUs trading in the system already.
Yeah.
And anybody who's dealing with any real-time availability, this isn't even a hot wallet, cold wallet distinction. I'm talking about how these are IOUs.
Well, the settlement is paper, basically, right? So
Correct.
that's what you mean.
Correct.
Yeah.
And this is where you can really get out of whack. Now, the SEC, the best thing Gensler did, the best thing he did was to not allow the custodians of the Bitcoin in the ETFs to rehypothecate the underlying collateral. Go read the fine print of other commodity ETFs. Almost all of them, the collateral manager can rehypothecate the collateral. So there's a lot of hidden leverage inside the ETF itself.
Yeah.
Thank God Gensler did not do that. He heeded the warnings of folks like me. I'm far from alone, warning that the ETFs were just going to be these supernovas if Wall Street was allowed to play the leverage games. And does that limit the upside? You bet. But does it make it more durable? Yes, absolutely. Yeah. It makes the market a lot healthier. Now, there's a lot of leverage on the ETFs themselves. And now I mentioned earlier, the options on the ETFs, there's leverage on the leverage of the ETF itself. But the underlying collateral by prospectus, and I assume that the custodians are complying with the law. Maybe they're not, but they're regulated, and they're audited. So there's probably somebody coming in. Again, to your point, some have better auditing than others because some understand the proof of reserves concept. But long story short, they're not rehypothecating almost certainly. If they are, they're breaking a lot of laws. But it's the trading of it and the liquidity providers where there's an awful lot of hidden counterparty risk for sure.
Would this change if I don't know what the other term was, but it's not in kind now, right? So you can only deposit money in the ETF when you buy a note, basically. Then they buy the
Physical
Bitcoin, and when you sell your note, you get dollars back. You cannot take the Bitcoin out, right?
Correct.
I think there was a discussion, or like the option is still open to change that.
Yeah.
So then you can put Bitcoin in, you can take Bitcoin out, etc.
Yeah.
Do you think that would change what you just shared?
Absolutely, it would. It would be good for our market. That's one of the mistakes the SEC did do. And in fact, actually, they forced a problem in the banking system. This is going to get a little bit esoteric, but you're going to now understand why Silvergate and Signature, the two U.S. banks that serve this industry, were so important to this market. And in particular, the SEN and Signet networks, which were 24/7, 365 networks, because the SEC forced onto the ETFs cash creates. So this is what you're talking about. Exactly. In like the Hong Kong ETFs, they're allowed to physically create the ETF unit. So stop and think about the cash flows. You can go Bitcoin to ETF, ETF to Bitcoin, back and forth. Okay. Yep. In the US, you go Bitcoin to cash to ETF unit.
Yes.
ETF unit to cash to Bitcoin. Right. So they threw in the extra step. Why did they do that? Because Gary Gensler hates us. And he did not want the broker-dealers to touch Bitcoin at all. So the only thing they can touch is cash. And so therefore and they can touch the ETF units. So he ring-fenced the exposure, the Bitcoin exposure outside of the regulated broker-dealers and banks, which is what creates the FTXs and other frauds of the world. But I digress. So anyway, long story short, that he thought he was throwing sand in the wheels because, of course, he hates this industry and he's trying to throw sand in the wheels. What he did was he created a big problem for the banking system. Why? Because you've got market makers in the ETFs like Goldman and like Jane Street, some big names on Wall Street, not just regulated banks like Goldman, but hedge funds and trading firms as well. But these firms are all big players on Wall Street. Okay. And here's the problem. Bitcoin trades 24/7. Fedwire is only open during banking hours. So what happens at 2:39 a.m. on a Saturday?
Yeah.
You're going to trade Bitcoin, but it's not, the US dollar leg is not going to settle. And remember, because of the cash creates, everything has to go in and out of US dollars.
Yeah.
So therefore, there's a bunch of unsettled transaction exposure. Last time I did the math, it was about 5 billion a day. Now that doesn't sound that much. It's probably doubled or tripled that right now. But I was looking at after hours volume and assuming that the other side of the after hours volume, a certain percentage of the after hours volume is the ETFs, and it has to go through dollars because of that cash create piece. So long story short, you've got big players with unsettled transaction exposure, waiting for FedWire to open to clear those unsettled trades. This is why Silvergate's SEN and Signature Bank's SIDNet were so important. There's only one of those networks right now. It's Customers Bank's CBIT. There are others trying to create them, and bank regulators have been throwing sand in the wheels because they hate us. They want us all dead. They want the crypto industry just, to go away. They've got their head in the sand, thinking that they have the power to kill it and to make it go away. And every time the price goes up, they must. I assume by now some of them at least are questioning their own assumptions.
Yeah.
But maybe not.
I think it's interesting because if they would have done the in-kind,
yes, it would have solved this problem.
That would have been better, but I think that would also have made it even more successful. Probably.
Correct. Which is why they threw sand in the wheels.
Yes, exactly. I love Bitcoin so much, but this is like, so you try to fight it, and you mess with yourself, basically. So that is poetic almost, but
poetic.
That's how it went. But it's perhaps, I do believe that with something, as the whole proliferation of Bitcoin, it goes like it goes, right? I mean, what you just said, I think is very clear. I think it's also very clear as to how that could be solved, which is just add the in-kind part, and you will see a way different dynamic.
Correct.
So I think a lot of rational arguments are on the on Bitcoin side, basically, and you know that this is a fight. I mean, you specifically, this is a very big. It's a very big fight. They're throwing actual resources and actual policy against something that is stupid and a Ponzi and a nothing burger, and it's not rational, and it shows you that it's actually a thing to pay attention to, I would say.
Oh, yeah. They're really afraid of it. I actually talked to a very, 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 very senior Fed official who was at the table when Custodia applied. And he actually said to us, the only thing we did wrong was crypto. So that's not what they said, of course. They threw out a parade of horribles about how Bitcoin's going to blow up the financial system, and Custodia, if we're allowed to operate as a non-lending bank, is going to bring down the entire financial system, right? It was just the hyperbole and the lies and the refusal to correct the factual inaccuracies. What did that really show you? It showed you how scared they are.
Yes, exactly. Yeah, because if it's not a threat, why would you pay attention to it? It's so. You have to look at these things from just a very simple perspective, I think.
That's why I feel for a lot of people as Bitcoin just goes up and up and up and up and
exactly,
up.
Exactly, Told you so.
At some point, they'll all do the same thing we all did. And I don't want to poke fun too much because let's face it, we were all skeptical, every one of us, when we looked at this and said, what is this thing? How does it possibly work?
Well, it threatens your bread and butter, right? I mean,
well, that's correct. It is a disruptor, and because it's a paradigm shift in terms of money, in terms of an asset, right? This gets back to the Ricardo Salinas and Michael Saylor points, and your point about the no degradation. We just don't have assets like that because every other asset has some costs associated with it and has some entropy, and even other hard assets. Again, gold, we talked earlier about why it has a yield. The history of why paper money came about in the first place. Gold was hard to move. You can't transmit it over telephone lines, right? Telecommunications.
If you move $100 million in gold, it costs you $10 million.
I'm not surprised.
Yeah,
I don't know that market, but all the Brinks trucks, right? They exist for a reason, and those things are expensive to move.
This is just
again, we had to do that in that transaction I was describing.
I mean, just those little things like, okay, we can now move $1 billion to someone in Hong Kong that we don't even know and don't have to see and don't have to talk to. Right? And we can literally do that right now with Bitcoin. People don't realize, when they're rooting against Bitcoin, they're not even rooting for themselves. You're also rooting against yourself because, if you still participate in the fiat money system, you participate in something that is not designed to help you in your individual life. You mentioned the ETFs. What are your thoughts on just ETFs in general, the massive demand for it? Is this like a Wall Street Trojan horse? Like, what are your thoughts in general?
For Bitcoin specifically, or for the the product, the ETF product
well,
generally.
that they became ETFs, and for example, when you see BlackRock, when you see Larry Fink talk about it, or Robert Mitchnick, who leads the digital assets part, right? Like, are they only in it for the money, or do you think there's like a bigger strategy? I mean, they talk about high inflation, they talk about monetary debasement, they talk about the unsustainable debt. Like they don't say USA after or in the sentence,
Right.
but you know what they are talking about, and you know that they fully understand this. So are they only in it for the money, or do you think they might even be prepping for like a Bitcoin standard way out ahead?
I'm sure there are some people, just like me at Morgan Stanley. I left in 2016. There were people like me, I wasn't alone, who was thinking about it as freedom money and thought that there would be a Bitcoin standard someday. The seventh network effect of Trace Mayer's 7 Bitcoin network effects is world reserve currency. I do believe we were going to get there someday, because I do believe that the transactional effects of Bitcoin and the efficiency are so great. And again, we haven't figured out how to scale it. Lightning Network has had huge strides, and then things tend to settle down, and we're kind of in a lull. And I see that on the users of Lightning Network right now. It's expanding as fast as I thought it would as a layer 2 payment system. There's a lot going on in the layer 2 ecosystem that's, I think, really great. In fact, my former partners at a blockchain startup called Symbiont, which worked with Wall Street firms, we did a production deployment at Vanguard for sharing market data on a blockchain. It was a distributed system. That was one example of where that architecture of a database made sense. These were private permission blockchains, but the guys who started that were the original founders of Counterparty. And Counterparty was the first layer 2 of any blockchain, and it was a layer 2 of Bitcoin. And if you go back and look at CoinDesk, the very first altcoin that's listed is Counterparty, because it's been around for 10 years. Exactly. Right. And so these guys they've reconstituted, I don't know how much I can say, but you can presume, since I'm even talking about this, that I'm helping. And it's a former director of Symbiont, and then the two of the 3 co-founders of Counterparty, who were co-founders of Symbiont, Adam Krellenstein and Evan Wagner. They're here. They're back. I very publicly welcomed Adam back not Adam back as in Adam back, but welcomed Adam Krellenstein back to Bitcoin, because he obviously took some time off. And after Symbiont unwound, I think he went sailing around the world or something like that. And now he's back, and he's just extremely talented developer. So why did I go down that tangent? Because we've got people like them coming back into Bitcoin, having detoured for a few years to work in other parts of the space, coming back to work on layer 2s. I am super, super excited about the layer 2 development. And ultimately, we all know that base layer Bitcoin already is a high value transaction layer. Nick Bhatia's book about layered money is, I think, spot on. It just like the current system, the scaling of the Bitcoin money system is going to be transaction layered, and we're going to have layer 2s, layer 3s, eventually layer 4s and layer 5s. I do believe that, because base layer Bitcoin is too expensive already to do most transactions. I bought my Christmas presents on overstock.com in 2014 with Bitcoin. I wouldn't do that today.
It's a nice gift.
Yes, exactly. I should have given everybody Bitcoin instead of buying things. But as a tangent, I don't regret that, because those of us who were early users of Bitcoin helped bootstrap the network. And it's $100,000 or knocking on the door of $100,000 now, precisely because people like us were using it back then. Otherwise, if no one ever transacted, it's hard to call it a medium of exchange, right?
Yeah.
And then it wouldn't have become a store of value.
Yeah. Yeah, I always share. Now with this price, I think I've bought like $15,000 headphones or something, and they broke in between already. So
yeah, there you go.
That's really
well,
cool.
But that's for your business. Yeah. Obviously, you justify it. But
so, like, the reason why I asked about this BlackRock thing, so I find it so fascinating. Like, I cannot imagine that they don't fully get it, like we get it. So they get it, right?
Well, they have a lot on the line, a lot more on the line than Bitcoin. Let's put it that way. They are very invested in TradFi. They are very invested in the US dollar system, and they have benefited handsomely from it.
Wait, that's where I'm coming from. So when I hear them talk, when I hear Larry Fink talk, I think like, okay, this is not a guy that has some PR person tell him what to say, right? So these are his own thoughts. That's my assumption. Same for Mitchnick when you see him, right? And like how they talk, again, they dance around the word U.S. debt, U.S. inflation, etc. But they know it. Exactly, your point is my part of a part of my point. Like they are a super winner of the fiat world. They are the king of the fiat finance money world, right?
Correct. Absolutely.
Usually, when you are the incumbent, when you are the winner, you milk that position until you cannot do that anymore. Why would you put one pretty big foot in like the other boat, in the other paradigm? And I cannot imagine. Maybe it's just greed and they want to make money. But that is my question to you. What do you think? Because if they really realize, the debt is unsustainable, they have to print, all these things that people talk about a lot. So there's unsustainable debt. Something has to change. You mentioned innovation. You can rationally argue that Bitcoin is better than fiat, is better than gold. It's everything. Again, I cannot imagine they don't see that. So them moving into Bitcoin, what does that tell you, or how do you think about it?
Well, I think there's two camps. Jameson Law has been tweeting about this for the last several weeks as well. There's two camps, and I am worried that we're going to have that the seeds of another tribal war within Bitcoin are already planted, because there's the number go up crowd, and then there's the freedom money crowd, is how I put it. And a lot of the financializers are in the number go up crowd. They will definitely talk about inflation. They will definitely talk about the debt problem in the US. But they look at Bitcoin as digital gold, and it's just another new asset to trade and to financialize and to make money off plugging into TradFi. And there's nothing wrong with that per se, as long as it doesn't dominate the freedom money aspect, right? And so the fact that Bitcoin is actually used as money outside of the United States is great, because that, and the fact that we can always self-custody, and frankly, that we can memorize our seed phrase in our head and walk across a border, is what makes Bitcoin freedom money. Okay? It can't be censored in that way. They're not interested in it in that aspect of it. And you don't hear them talking about it. The best example that I can give is when Howard Lutnick, who is he's probably stepped down as the CEO of Cantor Fitzgerald. He spoke at Bitcoin 2024 in Nashville, and Cantor Fitzgerald's it's a primary dealer, one of the 24 primary dealers of U.S. Treasuries. It's a huge financial markets infrastructure provider. And he was talking to Palm about the Bitcoin, about Bitcoin being freedom money. And his advice to this community was stop saying that, because that scares regulators. If you portray it to the regulators as this is just a new commodity, it's a digital version of gold. Yeah. Let's slot it in just like any other commodity and let's start trading it. His advice was that would make the regulators more comfortable. Well, I think that tells you which camp some of these prominent people are in. And as more and more people come into the Bitcoin ecosystem, I wonder how many of them are even sensitive to this distinction. Because I've never heard any of those big Wall Street players, other than Fidelity. Abigail Johnson at Fidelity has talked about Bitcoin as freedom money. But you don't really see the other big Wall Street players talking about self-custody. That's not in their interest. And talking about the fact that you could, escape an authoritarian regime by memorizing your seed phrase and take your assets with you. You never see them talking about those aspects of it.
Yeah.
That's very telling, I think.
It's interesting because I watched that interview too, and I do think this is also one of the things I wanted to ask you, like the digital gold. I think the digital gold is just like an illustration to get started in a conversation about Bitcoin. It's far superior than gold, but it's just to get people along on a certain direction of thinking so that you can like talk about it. But there's store value, there's medium of exchange. I personally think first we need to establish the store of value aspect before it becomes a medium of exchange. Like you can use it as a medium of exchange, but like if I don't want to save in it, why would I ask for it in a value exchange, right? So first I have to learn about that, and then that's kind of the sequence that I see it. I do agree with with the freedom money
sorry, go
part.
ahead.
No, I do
ahead.
agree with the freedom money part though. But when Lutnick said that, I thought, but this was a bit naive, so I think it's interesting to think about. Like, yeah, of course you don't say it's freedom money. Like, this is better money than the money that is like slushing around in your system. So if we don't mention the freedom money part, we slowly capture, this legacy system. That's kind of how my thoughts are around that. So I heard it differently than you, but I think it's really interesting that what you get from it is that it's yeah.
Precisely the fact that we have different perspectives is why it's so important. I was very much listening for this distinction here. Are we hearing any of the titans of Wall Street talk about Bitcoin as freedom money and really understanding? Go compare and contrast that podcast to any RFK podcast that he has recorded about
You're
Bitcoin
totally right.
in the last 6 months.
Yes.
RFK is truly orange pilled that Bitcoin's freedom money. And I haven't yet seen that other than from Abigail Johnson. And so again, from the Wall Street players, with the exception of the fact that there are people like me in all of the Wall Street firms that really do see it as freedom money. I think most of us probably have long ago left to go work on in the Bitcoin space. Yeah. But I'm sure there are more and more every day that get there. Now let's talk about, is Bitcoin better as a store of value first or as a medium of exchange first? Because you articulated something really interesting, which is that you think it has to become a store of value before it can become a medium of exchange. That's the opposite of the Misesian regression theorem. The Misesian regression theorem is, and this is where a lot of Austrian school economists don't buy Bitcoin at all. And they're some of Bitcoin's biggest critics, right? Peter Schiff is a perfect example of that, because the Misesian regression theorem says that money is a commonly accepted good that becomes a medium of exchange because it's commonly accepted, and it evolves through human behavior to become a medium of exchange. It doesn't say anything about store of value. So I spent a lot of time thinking and reading. Like I said, I did a big deep dive on all the different schools of economic thought. And I buy the Misesian regression theorem, where I think those who also buy that theory that money is a good that evolves to become commonly accepted in exchange, is that the Peter Schiffs of the world don't recognize that Bitcoin is a digital good, and that is a good that is evolving to become a commonly accepted medium of exchange. To a lot of people in the world, Bitcoin is money already. I acknowledge it's digital gold, but to a lot of people, to people in Nigeria, to people in Argentina, to people who in Venezuela who are living in Iran, people who are living in high inflation economies, they don't look at it as digital gold. They look at it as a path to survival. And it's also interesting, this is a separate but related tangent, that some people, like in Venezuela, there was a big story that came out probably 2 years ago now about people mining Bitcoin to be able to get Tether and to be able to get USDC. They were using Bitcoin as the means to get a US dollar. Yeah. We think of that as backwards, right? And so which comes first, the chicken or the egg? I actually very much do believe medium of exchange comes first. Store of value comes second. But that's because I believe in the Misesian regression theorem. I'm happy to be proven wrong and always open to new theories and to watching Bitcoin evolve. Right now, you're absolutely right. It is, to more users in the world, a store of value than it is money. But I love that it is money to a lot of people.
I 100% agree. I'm just saying, like, yes, it's better money. It's the best money to ever be created. The characteristics of money, it is a store of value, it is a medium of exchange, and it is a unit of account, right? So, I mean, you can already do that with Bitcoin. So I fully agree with that. I think it's more about the narrative part. So all the countries that you mentioned, of course, there it's more used as money. Yes. Right? That is the more primary narrative, I would say. That's the emerging narrative, the emerging usage and the emerging narrative. In Western countries, and I mean, we talked in the beginning about the money, and that you have to realize that the money is not real and it's not there and all these things. Right. People still think that is not the case, right? So they believe in the money, they use the money. Yeah. So I think it's more, which characteristic of better money do you highlight in which?
Understood.
If you want to work towards adoption, like what is the angle, or what is the touch point that someone gets it or gets into it.
Yeah.
So I think
Well, we
that
would
is
much
more where the
rather.
difference is.
Yeah, well, as a Bitcoin community, we need to continue to work on the user interface. It is still hard to self-custody. Like I said, early on, before ledgers and treasures, it was much harder. Then
Yes.
ledgers and treasures came along, but they were single point of failure. And therefore, there's all these collaborative custody structure that have evolved. But some people would still rather have a large financial institution with a balance sheet behind it holding a key, right? As opposed to a startup that may or may not survive long term. So some of these questions, I think there's going to be an evolution. And, it's going to be also very interesting how the regulatory change happens and the sequence of the regulatory change, because the big banks all want in for the reasons that we were talking about earlier. They want to be able to financialize Bitcoin, trade it, use it as collateral, and all of the above, right? Play Wall Street games with Bitcoin. That's what they want to do. They're programmed to do that. Bitcoin's a high volatility asset. The Fed crushed volatility in most other asset classes. So the traders are looking at this and licking their chops. So that's going to happen. And the question is that going to happen? Are the big banks going to be let in before the Bitcoin startups get direct access to the banking system? This gets back to the Custodian lawsuit. What's the sequencing here? Because I was talking to one of our shareholders this morning, and he pointed out, look, the incumbent regulators so favored the incumbents by throwing sand in all the startups to actively try to buy time for the big banks to come in and dominate this market. And congratulations, Elizabeth Warren, you made the big banks bigger. You and your crew made the big banks bigger. So, right, while you were out there railing against the banks, look at what you actually did. Look at what you actually achieved. You kept a lot of innovative startups down while you handed the market to your big Wall Street friend. And that's the impact of money in politics. And the crypto industry obviously wrote big checks in this election. And so I think it has turned the tables. And it's going to benefit the crypto industry because the Genslers of the world are going to be gone. But the sequence of all of this matters, right? Because the Fed let Bank of New York Mellon be the first large bank to get into Bitcoin custody. They're a huge custodian. How can a small startup in the custody space that has a trust company charter, for example, compete against Bank of New York Mellon, which is a bank and has direct connectivity into the Fed and a huge balance sheet? These are the questions that we're going to be answering in the next 6 months, and how the regulators try to get us back because they're so mad at us for helping to put the U.S. election over the top and them losing power. I have been told by an insider that this Gensler, Biden, Warren crowd is going to be on one last rampage before they lose power. And he used the word rampage. Wow. And I do believe that that's happening.
Before the transition, you mean?
Yes. Oh, absolutely. Absolutely. Okay. Custodia announced after the election that we'd been debanked again, for example.
Yeah.
This is recent stuff. Absolutely. And I'm seeing it. There's some things I don't want to out other companies for, but I'm seeing it. They're doing this, the regulators behind the scenes, right? While they're rolling out the red carpet for the big banks.
I wanted to ask you 3 last, hopefully short questions. I want to be mindful of your time, but maybe one question before that. Isn't that like very un-American, what you just
Of course it is.
Yeah.
This is part of the reason why I'm so excited that Elon and Vivek are going to take on, and let's see if they succeed, major government cuts. Yep.
Yeah, very interesting to see from a distance, by the way, like not being in it, but it's just in general, I think why we focus so much on America, like it sets kind of this precedent for, I don't want to say the rest of the world, but especially, Western Europe where I'm at. So it's going to be interesting to see. All right. My last question is, do you think we're still early?
Of course.
Yeah. Well, I mean, 15 years in, if we talk about the big battle that we talked about, then I would also say it's still pretty early, right? Yeah. What are your thoughts on like global game theory or this strategic Bitcoin reserve that Senator Lames proposes, where apparently there's quite some support. I just saw some Reuters alert where people talked about, they are going to keep the promise and do it, something like that. That was some sort of alert. Yeah. What are your thoughts on that? And do you think that kind of can kick off this more like global game theory where there's like other sovereign, like other nation states that come in here?
Well, look at El Salvador. The TradFi space laughed at El Salvador, and who's laughing to the bank now? And, you know, having them be able to, through their Bitcoin gains, to defease their debt. I mean, they clearly have been the first to show it. There are other countries, small countries so far, following suit. The interesting game theory is the control of the hash power. And you know, this is the Jason Lowery thesis that it ultimately in the new world game, in the new world, you know, we've had such small q quantum leaps in the technology gains, and most of them are coming from the westernized world, from especially the US. And so how does that actually change the geopolitical dynamic? I think he opened a lot of people's eyes. I know there's some critique of him and thinking that he's a spook and, you know, kind of a Trojan horse in, you know, from the US government into the Bitcoin community. I've never met him. I have no idea, but I always like listening to people who open my eyes, and he opened my eyes and saw through a national security game theory paradigm how the US could really lose. And I agree. I think it was Nick Carter who said one of the worst geopolitical decisions made in the last few years was China's decision to kick the Bitcoin miners out. Because, man, now not only would there be more wealth in China, because the Bitcoin miners ended up in many cases setting up shop in the United States, especially in Texas. Right, that's changed the Texas economy. It's changed the grid. It's stabilized the grid. That's just going to keep happening. You know, I don't have all the answers, but I do believe that the balance sheets matter. We've talked about that before. Balance sheets matter. The U.S. has a crappy balance sheet, really crappy balance sheet, and obviously, if we own Bitcoin and Bitcoin goes up by more than the dollar goes down, then the U.S. gets ahead. It will have been a really good decision. And I will end by saying, before anybody gets too excited about the US government's Bitcoin stash, remember that Bitfinex has a claim on, and probably a very real claim, that those Bitcoins that were confiscated by the US government actually belong to Bitfinex because of the way that hack went. And I acknowledge that might actually be true. And I don't know if there's anything going on behind the scenes, but just be careful before you conclude that the stash of Bitcoin that any government has is legitimately owned by the government. It may take years to clarify who's the real legitimate owner of the Bitcoin that a government has confiscated.
That's a very good point. And maybe that even creates more urgency to buy other Bitcoin or mine it, right? But also, as you said, and I agree, once you adopt Bitcoin as a country, you have to mine it because you have to own a portion of the hash rate to at least have some transactions that you really want to go through. And I think maybe we then go back to your example of the was that 2.5 billion? What that you said? Your example in
of the cash we were trying to move.
Yeah. Well, if you have a certain settlement as a country, you need to make sure that transaction goes through, right? So you need to have.
Actually, I think it was 3.5 billion as I'm thinking about it now.
Yeah. But you need a part of that hash power, right? And I think, in essence, for me, that's kind of like the thesis of software. Like you have to protect yourself, so you are forced, incentivized, to participate. You have to mine if you adopt Bitcoin as a state as well.
And maybe this is a good place to end, because we're going to be drill baby drill in the Trump administration. I'm sitting in the state of Wyoming, which is a very mining and energy production intensive state. And frankly, nuclear's coming here too. Bill Gates announced that he was putting that small nuclear facility here. There are multiple nuclear projects that I'm aware of that are being developed in Wyoming to power data centers. And I'm located in Cheyenne, Wyoming. You were talking earlier about, if there's war, taking out the data centers. Well, Cheyenne, Wyoming has always been a target because the nuclear missiles, it's the Air Force base that I'm very close to located here, it dominates the town, is where the U.S. nuclear fleet is controlled. It's one of the Air Force bases where the U.S. nuclear fleet is controlled. Well, guess what? It's also on the backbone of the internet because of where the highways are, where they laid the fiber optic cable. So it's super low latency. So we have a whole bunch of data centers here, and Microsoft, I think, has 3 now, and Meta's coming in, right? Because low latency, cheap power, and so it's funny when you were saying that earlier, and I was thinking, as a kid growing up, we used to recognize when I think it was Dan Rather went to Moscow, and he was interviewing somebody who controls the nuclear missiles in Moscow in the 1970s. And he didn't think that the guy would answer the question, but he thought he'd ask it anyway. And he said, "Where is that nuclear missile pointed?" And he immediately responded, "Cheyenne, Wyoming."
Oh, no way.
And not a lot of people understood at that point why you were asking earlier again, like, does Moscow know where all the data centers are? You bet, right? They know exactly where all this stuff is, right? And so I'm quite sure that they've got, they might have moved it a few miles from the Air Force Base to the data centers now. But this is the point, right? Wyoming is in the center of what is, I think, going to be an incredible energy renaissance, because all the permitting to do these kinds of things is going to get streamlined. We're going to drill, baby, drill. There's uranium here. There's lithium here. Oh my gosh, where I am is going to just boom. If all of these things, if Trump does keep his promises, Bitcoin miners are going to be coming in spades. Texas has been historically a lot cheaper because of the grid being deregulated. Wyoming, unfortunately, has not deregulated its grid yet, and it's got such a vast distance because it's a huge. I mean, it's much bigger than. Wyoming is bigger than probably Germany and France combined. Just the amount of land here, and it's sparsely populated, right? So, which is one of the reasons why it's a good place to put the nuclear missiles and to put nuclear power plants. But long story short, it's coming here, and then the renaissance that's going to come here is just going to be amazing. And the power prices are going to be coming down as more nuclear comes onto the grid. And Wyoming is going to be the next Texas. It might take a few years, but Wyoming is going to be the next Texas for Bitcoin in terms of the importance of this industry to the state's economy. And it's fantastic because it couldn't be a more welcoming place for the Bitcoin industry.
Well, I hope it will be like that. I do want to ask you my last question, because I ask everyone the same question, which is, what is a core belief that you will never let go?
Sound money. Fix the money, fix the world.
Awesome. Well, that's a great ender. Thanks so much for this fascinating and enlightening conversation. Thanks again for your time. I really appreciate it.
Yeah, really great to be with you. Really appreciate it. Great questions.
Thank you. Cheers.
I hope you enjoyed this episode. If you did, you can click here to find more just like it, and click here to find all Bitcoin for Millennials podcast episodes. Also, please like this video if you want to help shine a light on the message of Bitcoin, and subscribe to my channel to stay connected. I hope to see you for our next episode. Bye.